our Social Security benefits are an enormously important way that most of us plan to be able to afford to finally be able to retire. In fact, the Social Security Administration estimates that well over 50% of all U.S. households over 65 use Social Security to pay over 50% of their monthly expenses. But did you know there's several ways, common ways, that people can lose their Social Security benefits? I don't want this to happen to you, so let's jump in and talk about it. And the first one is we need to talk about the earnings limit. It's continuing to work before you reach full retirement age. So for most of us, we can start taking Social Security at 62. For most of us watching this video, our full retirement age is 66 to 67. So if we start taking Social Security before our full retirement age, but we keep working, that can work against us. And here, according to the Social Security Administration website, and this is a site called Receiving Benefits While Working, or an article on that. And here the Social Security Administration says, if you're under full retirement age, which for most of us is going to be 66 or 67, the Social Security Administration is going to deduct $1 from our benefit payment for every $2 we earn above the annual limit. And for 2024, if in the years that we're working before the year that we have our full retirement age, that limit is $22,320. And I'm going to give examples here in a minute, so stay with me. Now, in the year that we reach our full retirement age, the Social Security Administration is going to deduct $1 in benefits for every $3 that we earn above the 2024 limit, which is $59,520. So here's an example. The first one is somebody is under the full retirement age and they're entitled to $800 a month in Social Security, which would be $9,600 for the year. And in this example, and this comes from the Social Security Administration website, ssa.gov, the person works and earns $33,220. Now, these are weird numbers, but it essentially gives them $10,000 more than the $22,320 limit in 2024. So therefore, because they've earned $10,000 more for every $2 that they earned, Social Security Administration is going to reduce their benefit by $1 for every $2 over that limit. So it's going to be reduced by $5,000. And then they would receive $4,600 of the $99,600. And as the example shows, that's just $9,600 less that $5,000. Now, in the year that you reach your full retirement age, in this case, they're saying August of 2024, same example, $800 a month. And this person worked and made $69,000 during the year. And during the year, they reach their full retirement age. So the Social Security Administration is only taking that 7 months before they reach their full retirement age. And so $63,000 of that was earned in that 7-month period, which was $3,480. Now, in the year that you reach your full retirement age, the Social Security Administration is going to reduce your Social Security benefit by $1 for every $3 that you earned above that limit. So in this case, the person is going to have their limit lowered, their benefits lowered by $1,160, which is 1/3 of what they earned, that $3,480. So they're going to have their benefits reduced. They'd still receive $4,400 out of their $5,600 of benefits during that 7-month period. So they're going to be reduced. That $5,600 that they would have received is going to be reduced by $1,160. And then beginning in the month that they reach their full retirement age, then they can earn as much money as they want. And then the Social Security goes on to say that they only deduct from your benefits, they only count wages you make from your job or your net profit if you're self-employed. They do include bonuses, commissions, and vacation pay, but they don't count pensions, annuities, investment income, interest, veteran benefits, or other government or military retirement benefits. So that's how that works. It's important that you know the Social Security Administration website also has an earnings calculator. You can see what that looks like here. So that's the first way that people can lose their Social Security benefits. The other way is by taking their benefit early. There's 3 ages that I want you to keep in mind. Age 62, your full retirement age, which for those of us watching is either 66 or 67, and then age 70. If you take your benefits early as 62, you're only going to receive 70% of your full retirement age benefit. And then if you wait till 70, for every year that you wait past your full retirement age, you're going to get an extra 8% per year until you reach 70. And then you don't have to take your benefits, but they're not going to increase anymore. So few people would do that, right? It makes sense for us to start taking our benefits by the time we turn 70. But if we wait till 70, we'll get 124% of our full retirement age. So that's the second way that people lose some of their Social Security benefit, is by taking their Social Security early. That's probably the most common way that people do. I do want to share, and I should have mentioned earlier with that earnings limit, that's not money that in theory you lose forever. Your monthly payment is going to be increased in part based on how much money you gave back because you were earning. But if you were to pass away early, probably, somewhere in your mid-80s, you probably will not make up how much money that you paid back to Social Security during that. Okay, so that's items 1 and 2. The third one is, the nice thing about Social Security is it's protected from debtors. Most debtors. Let me tell you about the debtors that still have a claim on your Social Security payment. And that is if you owe government debts, such as if you owe the IRS money or you owe student loans. And surprisingly, a lot of 50-plus-year-olds still owe money on their student loans, or if you have a small business administration loan. Also, wages, your Social Security payment can be garnished if you owe child support or alimony, or if you've been convicted of a crime and you owe victim restitution. All those things, your payment can be garnished. And then the fourth one is your Social Security can be taxed. Now, importantly, if you look at your paycheck, you'll notice that you pay your Social Security tax with after-tax dollars. That does not happen above the line. That happens below the line. So you figure out how much you earn, the government taxes you on that, and then you pay your Social Security tax, your Medicare tax, your payroll taxes on that. So we're paying for our Social Security benefits in after-tax dollars, but unfortunately, our Social Security can be taxed. It's not always been that way. In the 1980s, Ronald Reagan signed a bill into law that allowed Social Security to be taxed up to 50%. And then in the 1990s, then President Bill Clinton signed a law that allowed up to 85% of our Social Security to be taxed. But if we look at that, the way the calculation is done, if you do a search on Social Security combined income, you can learn more. But essentially, you take your AGI, your adjusted gross income, you add back into that any tax-free income, tax-free interest, which for most of us is going to be from things like municipal bonds. And then we also add back into that half of our Social Security. And when we do that, if the total is more than $25,000 for a single person, you're going to owe some tax on your Social Security. Or if it's more than $32,000 for somebody filing jointly. So I hope you found this helpful. If you did, I made another video that talks about the average income for retirees in America. I know you'll enjoy that video if you enjoyed this one. See you in there. Bye-bye.